The DHS retirement trap. Why eligibility alone doesn't guarantee income. Security. Most DHS employees spend years preparing for one milestone: retirement eligibility. You track your age, you count your service years. You wait for the moment when the rules finally say, yes, you can retire. But here's what many DHS employees don't realize until after they leave service. Eligibility does not guarantee income security. In fact, some DHS employees retire fully eligible and still experience income gaps, delays, or long-term financial regret. Not because they did anything wrong, but because the federal retirement system works very differently than most people expect. Let's explain what's really happening. First, retirement eligibility is just permission. It's not optimization. Eligibility simply means you're allowed to retire under federal rules. It does not mean your income starts immediately. It does not mean your benefits are coordinated. And it does not mean your retirement is structured for long-term stability. For DHS employees, whether you work for TSA, ICE, USCIS, FEMA, CBP, or as a DHS civilian, retirement income comes from multiple systems that do not communicate with each other. Your pension is handled by OPM. Your thrift savings plan is administered separately. Social Security follows its own filing rules and timelines. None of these systems turn on automatically. None of them are synchronized by default. That leads to the first major retirement trap: timing. When you separate from DHS, your paycheck stops immediately. Your pension, however, must be processed by OPM, and that takes time. Your TSP requires withdrawal elections and processing. Social Security only begins if and when you file and qualify. This is why many DHS retirees experience a gap between their last paycheck and their first reliable retirement income. Nothing went wrong. The system is working exactly as designed. The second trap involves pension calculations. Your first pension is calculated using 3 permanent factors: your high 3 salary, your years of creditable service, and your multiplier. Once OPM finalizes that calculation, it's locked in for life. Many DHS employees retire the moment they become eligible without checking whether waiting a few extra months would increase their high 3 or service credit enough to permanently raise lifetime income. That small timing decision can compound over a 20 or 30-year retirement. The third trap involves retirement elections. Federal retirement isn't just about receiving benefits. It's about choosing them. Survivor benefits, health insurance continuation, and payment options must be elected during the retirement process. Once OPM finalizes your file, many of those choices are difficult or impossible to change. They may look like checkboxes on a form, but they translate into lifetime income math. Finally, there's the assumption that TSP will fill the gap. TSP is flexible, but flexibility without planning often leads to higher taxes, Medicare premium surprises, and faster depletion. How and when you withdraw matters just as much as how much you saved. This is why 2 DHS employees with nearly identical careers can end up with very different retirements. One focused only on eligibility, the other planned around outcomes. The takeaway is simple: eligibility ends your DHS career. Planning determines how retirement actually feels. Understanding timing, elections, and income coordination before you retire is what protects long-term security, long after your last day of work.